Selling your e-commerce business is different now than it was a few years ago. It is important to have your ducks in a row and get ready to face today's reality. Today, I'm talking to a friend of mine, Yael Cabilly from Fortunet, one of the investment banks we partner with to help our brand owners exit when the timing is right. What's great about talking to Yael is that she sees a ton of deal flow, a lot of transactions. She understands how the buyer market is evolving and how sellers like you and me need to get optimized for the exit that we want to have in the next year or two. So I hope you enjoy this conversation with Yael. We're going to talk about how the landscape is changing, what her advice is for getting the most money for your business, and some other things. So enjoy this interview with Yael Cabilly with Return on Podcast. It's time to maximize profitability and cash flow. It's time to learn habits and hacks from the best e-com CEOs. It's time for Return on Podcast with me, Tyler Jefcoat. All right, welcome to today's episode of Return on Podcast. I am excited, guys, to talk to my friend Yael Cabilly of Fortunet. Yael, welcome. How are you doing today?
Great. Hi, Tyler. How's it going?
Life is so good. We were talking about before we hit record. It's like summer chaos rhythm, and some of that's really fun. Going to the pool with my kids, sleeping in a little bit. Some of it is like more chaos than I'm used to, like a mistake of working at home, right? But how about you? How's the summer rhythm for you so far?
All good, all good. Working hard. I'm waiting for August when it gets calmer. But yeah, starting well.
Okay, all right. August, maybe that'll be calm. Who knows? Well, yeah, I want to talk about exits. I want to talk about the M&A landscape related to e-commerce. But before we dive into that, I want to get a little bit of your story. You're an amazing woman. You've built some really incredible models, and you're killing it. And I just want to, at one point you were just a lowly attorney, and now you've launched your other models. Like what was it that was going on in your life where you decided, you know what, I'm going to go launch my own business?
Well, so it started with the legal part. I was a trademark attorney, and then it starts with a client. So started with an Amazon seller who needed help on the legal side on the trademark, and then I helped him get out of a trademark infringement case. And then he told his story on one of these groups of Amazon sellers, and then 20 sellers came to me, and then we did a webinar, and then like 40 sellers came to. So I realized there's a thing here, and it's an interesting area. I opened my own account, started playing with it, and then I started first the law firm. So that's kind of the beginning of my Amazon story. And then later, a few years later, Michal and I started Fortunet, which is an investment bank where we help e-commerce businesses generally selling their business.
Love it. And so I want to talk about the current landscape, but just for people who are not real familiar, I sometimes kind of get confused by this. But if somebody asks you, what's the difference between like a business broker and an investment bank? Are those the same thing, or is that something different?
I mean, there are some differences and some similarities. So in our space, for example, the brokers are very often these platforms where you can post your business for sale, and then buyers can approach you through the platform. The broker would present you to that acquirer. So that would be one process. An investment bank is very often it's for larger businesses, and then you would go through an entire process. So it starts with when you're thinking about the sale of the business, the preparation. There's a whole preparation of how to tell the story of your brand and what a buyer could do, or a buyer could take that business and an opportunity for growth, etc. And then we hold your hand through the next stages. So we would present it to all the relevant buyers, only specific ones, specifically for this particular business. And then you go through the negotiation stage, we would hold your hand through the due diligence process until really the deal is closed. So it goes a little deeper, and usually it's more like a selective and exclusive buyers, as opposed to a very, very large pool of buyers that may or may not be relevant. But there are, of course, some similarities, and many of the brokers do kind of the same and go through the entire process.
Makes sense. Yeah, I think when I talk to friends like you that are in the investment banker space, you seem like you guys are kind of working with larger, more complex businesses. And like you said, it's kind of a little bit more, feels more like kind of a white glove M&A
Exactly.
process. And that makes sense for sellers that are trying to, kind of capture the top end of the market, right? Or trying to get a little bit more for their valuation. So, well, speaking of the buyers, and you mentioned the buyers here a minute ago, I feel like I'm seeing some evolution in the kinds of outfits, the kinds of investors that are buying e-commerce businesses. But I mean, you have a front row seat at this. I'm curious, what are you seeing in terms of how the buyer types are evolving for sellers?
Yeah. So while 2-3 years ago, if many of the e-commerce businesses were sold to aggregators, so there was Thrasio that kind of started uh, the aggregator space, and then there were almost 100 different aggregators at some point. Today, and it started back then, but today they're even more active. Today, most of the transactions, at least that we've done, were either with private equity firms or with strategic buyers. There are still many e-commerce operators. Some of them were, the aggregators that we know, maybe 10, 15, or close to 20 are still active and buying. And other large e-commerce operators, I don't know, one of the top 50 Amazon acquirer, or other e-commerce operators. So these are the three types: PEs, strategics, and e-com operators.
That's a pretty, like you mentioned, that's a pretty dramatic shift from, I'm guessing, this is just from my experience, I'm guessing something like 4 out of every 5 deals back in 2021 was to an aggregator, right? It was an insane percentage of the market was that $15 billion of capital flooding into the space to acquire these e-com and Amazon businesses. And now, this is another one. Just want to like definition here. I mean, this is an investor podcast, so most people probably know what a strategic investor is. But give us a quick sketch of what really separates an investor that would be highly strategic.
Yeah. So, if you're in the, I don't know, retailer, or you have a large, I don't know, kitchen brand, and you would look to acquire a kitchen brand on Amazon, or a Shopify kitchen brand. So that would complement your current brand. So that would be, or a large toys company that would acquire a D2C baby brand, or toys brand. So kind of completing and expanding your current portfolio. By the way, sometimes it can be a strategic deal for a private equity, of course. But this is kind of the definition, and very often, as opposed to PEs that would want the team to continue to operate the brand. With strategic, they may be more flexible, because they often would continue to run the brand themselves. It would merge into their current operation, so maybe a year or two, or even less, they would continue, as opposed to PEs that very often would want the team.
Makes so much sense. Actually, that's a really clarifying note that you made there, is that a lot of times if you're looking to exit a business, you're trying to decide, what is it that I want to do next? Do I want to stick around and work a job for the man that now owns my business, or do I want to go do something else? And the more operationally solid your buyer is, the easier it is to kind of remove yourself from the business. Whereas if you're really getting a green buyer, a buyer that's an investor that doesn't really know your space or your category, the likelihood of them failing without your help is really high. And so it's funny, we get kind of harkens back to the aggregator discussion again, Yale, where
Exactly.
we didn't have enough operational excellence in our investment pool, and as a result, some of these brands really didn't do well, right? I mean, I'm sure you saw that as well, right?
Everybody liked to talk about it back then, right? Can these MBA, Harvard MBAs really run the businesses better than the current owners? I think it doesn't matter who that is, a new person. It takes time to merge these brands into the operation, to take over those brands. Yeah, and the result was, what we saw. Although if you look at some of the aggregators, they're actually really successful today. So, but I guess the biggest is had a huge impact on the on our industry.
Yeah, it really makes sense. It is kind of funny because I do wrestle sometimes because you and I both were doing some advising of some of these aggregators over the course of the years, and I just wonder in hindsight how much of the thesis error was we thought we were going to be better at this. Like that's probably one part of the problem. We under resourced our operational team, and then how much of it was that we just maybe overpaid for some of the assets, which was again is great for your clients and my clients, right? We made a killing. We were really happy. But I wonder how much of the thesis was just flawed in terms of can we really aggregate this level of complexity under one operating umbrella versus no, we could have done it. We just overpaid for the assets and the house of cards fell down. I mean, do you have any opinion on kind of
Yeah,
what the
it
balance is?
depends, right? But no, I think that some of them absolutely may have overpaid, and for
Yeah.
for some of the businesses, we were surprised of of what the market had offered by then. Back then, we always opened. We never had an asking price because the market kind of speaks for itself, and the market decides. But I think that at the end, these businesses have proved to be solid as long as they're managed well, and there's evidence for that for those who actually succeeded. And I think you touched on the very relevant point. It's not so much about. I mean, there is the thesis of economy of scale does make sense. We saw it successful, but it's very hard to do it. You need very, very good operators, and one of the so-called aggregators that we know, we call them operators because this is what they are. They started as sellers, and then they started acquiring brands, and then they took over. They did very well. And so I think there are those who left the owners for a year or two. They're also thriving today. So at the end, it's about managing those businesses well, paying the right price, of course, but really having the right people taking the lead on these brands.
Beautiful. Yeah, I think that makes a lot of sense. So I mean, can we talk about, let's talk about valuations a little bit. Like, what are you kind of seeing, guess what, guys, it's 2024. The values are a little bit different than they were a couple years ago, but they may not be as awful as some people have feared. I mean, what are you seeing as you kind of see more deals come together here in the middle of 2024?
Yeah. What we see is, first of all, what we see is that some businesses are difficult to sell. So, while a few years ago, any profitable, growing, even Amazon business or D2C business could be easily sold. Today, they're looking for sometimes specific categories. They're looking for some differentiation. Not just any lookalike brand that's making money can be acquired or can be sold. I think that in terms of the valuation, there's a huge change here. What happened is that there's a very wide range. It can be 2 to 3x on some of the smaller brand, and it can go as far as 3 to 4x on the revenue for some of the the larger businesses with recurring revenue, not dependent necessarily on Amazon, for these e-commerce brands, especially in the beauty industry where there's recurring revenue, you could get to absolutely amazing valuations. So the range can be very wide, from like 2 to 3 to 15 on EBITDA. Really depends on what your brand is, the size, of course, the team, the differentiation. That's where it all yeah.
Well, so let's double click in there a little bit. So, what are some of the other? Obviously, having a larger brand with seven-figure EBITDA, having premium margins, having kind of believable growth rate that isn't spiked and then back down. There's some things that make the business solid. You mentioned the team. What else are you seeing that really drives premium valuations with brands?
So one example would actually be the recurring revenue.
Uh,
Of course, not that's not the only type of businesses that obtain good valuations, but we've seen that this really pushes the sometimes 2 or 3x, the 2 times or 3 times the regular valuations. When you have like subscription, we just talked about it recently. And the reason is that buyers generally like lower risk. They and when they look at businesses like that, there's you can already forecast. There's recurring revenue. You can know more or less where you are and how the year will look like. And you can plan everything. You can plan the inventory. You can plan the entire year ahead. That reduces the risk dramatically. And of course, when you're less busy with bringing new customers all the time, then your marketing costs go down and your margins go higher. And so the return on investment is better. And that's why a lot of buyers are attracted to these type of businesses.
yeah, really good businesses. I'll give you an example from our clients over the last few years. These guys built a really good product that went in a home, but then they were actually, and so that was a high dollar product. It was a $300 or $400, retail price kind of product. But then it had a filter element to it where they were able to build a filter club that gave them some recurring repurchase. Whether if it was on Amazon, it would be subscribe and say, but they actually created a filter club on their website as well. And to your point, when they went to exit, they were able to get a tremendous valuation because of what you said. They've acquired their customer. The customer is very sticky. They already had good margins and good supply chain with the primary units. But now,
Yeah.
guess what? They're going to make several $100s a year just in filter refreshes for this customer in perpetuity. And you don't pay a dime for that additional traffic. And so that's a great case study. So guys, when you look at your brand, you're kind of deconstructing your value proposition to your customers. Is there anything tangentially connected that you could turn into a subscription or recurring revenue model? According to Yale, and I believe her, this could double the value of your business. Anything else you'd like to add to that, Yale?
Yeah, I mean, I'm trying to look back while we talk at those who received the highest valuations of the businesses we talked about. Other businesses that are not necessarily in the recurring revenue under the recurring revenue model would be businesses with very innovative products. So, for example, one of the businesses that we sold that had really good traction and a lot of interest was a business actually in the kitchen category. They had 20 or 25 different products. Each of them had a design patent. Each of them had a very unique design, and they also had a team, like a machine of inventing new product, new innovative product. Acquirers were attracted obviously to the existing portfolio, but also to the team that keeps generating that. And this is what they got. And in that case, actually, the team wanted to continue to develop products, but not necessarily, continue with the business side and then the marketing and the D2C and Amazon. So that was really a good match, and the valuation was fantastic on that particular business. So either innovation or just businesses. We have a business now with a lot of interest because of the tremendous growth, and the margins are just very, very high. So sometimes that's enough.
Yeah.
So yeah, these are the types of things that attract buyers.
I love it. To go back again to your comment on the kitchen brand, and we also had one in our portfolio that kind of same. Like, guys, think about this. If you're looking at your P&L and you're able to have a cost of goods sold, product cost of goods sold that is less than 20% of your sales, that normally means that you have, what Yale and I would call a highly differentiated product. You have a really premium offering where your customer will pay a delta much higher, right, than the kind of the normal. But how do you get that, right? You can't just like wave a magic wand and have a differentiated product. You actually have to design things that are different. And if you design it and figure it out, you need to protect it, which is why that, back to your background, Yale, with the trademark and the patent law being so important. And the guys I'm thinking about did that. In fact, he invented something kind of also kitchen-ish, patented it, great design. They had a Kickstarter launch, sold, $1 million worth of product before they even got the first container because it was such a cool idea. And then guess what? Everywhere that product touched turned to gold. Amazon, gold. Shopify, gold. Indiegogo, gold. Like everywhere they wanted to sell this product was a win. And to your point, all they had to do was rev that engine of product development and keep launching new SKUs. And ta-da, you've got an 8-figure exit, and that's obviously one really nice way to do it.
Yeah, no, absolutely. I mean, sometimes we look at the products that their clients generate. This is just wow. And sometimes, we look back and wow, we sold this business at 25-40 million dollars, and this product already existed. They just did a very, very good marketing job at pushing this product. They didn't invent anything, but a really good marketer, and this is where they got, and their brand becomes very strong. So yeah, sometimes it's the product, and sometimes it's just genius marketing.
Well, I think that's another great point there, just as we kind of land this part of the discussion is I try to tell my clients, I'm sure you do yours, it's okay to be you. Like if you're not an inventor, like I'm going to be honest with you, I've now launched, 2 7-figure companies and I love what I do, but I haven't invented anything. I wish I was an inventor. I wish I could sit down and put up a whiteboard and come up with some clever new idea that's going to address the market. I so far have not demonstrated the ability to do that. Hence the accounting degree, right? Like, but I think being able to execute better than your competitors can still give you a winning advantage. And you don't have to be something you're not. Just be you, but be great, right?
First of all, compared to other accountants, you're great and you're very innovative. So within I'm a lawyer, so I
That's true.
can't. Yeah. So, but yeah, no, I agree. I mean, not everybody invents anything, but sometimes it's you find the right way to differentiate yourself, and sometimes that way more than enough.
Yeah, but actually, you bring up a good. Thank you for your kind words, and same to you. But I think no, the bar intended, pun here, but like the bar is relatively low in our industry in terms of being able to communicate effectively and generate value for clients. And so, what you and I can do, Yale, is we have the opportunity to just kind of be better humans. I mean, just like just communicate it better, just speak clearly, and I'm grateful that we can carve out some edge with that. But well, this has been a great conversation. So, but as we're kind of looking to kind of zero in on the end of this episode, any other advice you would give? I'm going to build you a case study. So this is a brand that's probably 50-50 Amazon, Shopify, 5 million in revenue, maybe trying to get to $1 million EBITDA, but they're not quite there, and they have a 1 to 2 year time horizon to try to exit. What kind of advice would you give her to try to really maximize the opportunity for 2025?
Yeah. So first, when I have conversations, it's always good to start having conversation quite early in the process, maybe a year or two before you exit, so that you can start preparing. We had, we thought about it a lot, what can be done at that stage, and we developed some tools even for, for these preparing to sell one day. So there we have a kind of the due diligence tool to make sure that you would pass a due diligence. So and it actually gives you clear things that, hey, you didn't, cover your trademark in all the territories, or in all the different classes, etc., etc. So that's one tool, and then there's another tool that shows you where you are compared to the benchmark. So do you have, is it a good tacos? Is it a good ACOS? Or is your cost of goods high, or actually low? Is it, so kind of know where you are. So my first advice would be, start having conversation, understand where you're good and where you should improve during those 2 years. If you know that your cost of good is extremely high, now is the time to, to negotiate with your supplier, or find new suppliers, or, or change completely. So that's just one example, but sometimes the marketing is a problem. So first, if you want to exit in 1 or 2 years, understand where you're good and where you're not. This starts usually with the financials. So if they work with someone like you that really presents a clear P&L, this gives a clear idea. When we get that, we can speak with you and say, hey, it's very clear that you have a problem here, or it's very good, it's very clear that you're excellent, and just continue what you're doing. So it starts with obviously the financials, and then an analysis of each different part of your business. See where you are. The next step is start having conversations with potential acquirers. So as you go closer, with businesses that we speak with that are already at 10, 15, 20 million, and want to sell in the next 1 or 2 years, we sometimes start having those conversations with potential buyers. This business is not for sale right now, but they intend to go to market in January 2025. And then every month or two, the buyer knocks on our. So are they in the market? No, not yet. Are they in the market? Not yet. And then when you go and sell the business, these buyers are prepared to acquire your business. So when you're a year away, it's good to start having those conversations, especially if you intend to sell to PEs, strategic buyers. That can take, sometimes it can take more time to prepare. So like I said, understand where you are compared to the benchmark, and start preparing and having conversations early.
Such good advice. And it's interesting. We had a case with one of our clients like that, where he is like, all right, we're getting close. We're not quite ready to exit yet, but started talking to potential buyers in the market. And and his thing was, hey, my number is here. I'm not quite there. I'm going to keep working. I want to get you guys. And they went ahead and just made him an offer for his number after, he told him no for 2 months. And then they eventually were like, hey, our, our money's ready now. We don't want to wait for you to be ready. You are a strategic acquisition. And he went ahead and just got the number that he thought he was going to have to wait 6 months to get. And so I think having those intelligent conversations, creating some kind of buzz and demand for your business, especially if you're doing really well, you might be surprised at what happens.
Yeah, absolutely.
Well, yeah, this has been a good conversation. I'm going to make sure that your contact information, fortunet.net, we'll make sure the website's in the show notes. But who listening to this show should reach out to you and your team to kind of get more counsel? Anybody in particular you want to make sure hears you and reach out to you?
Yeah, I mean, if you'd like to have an initial conversation about where you stand, what's your current valuation, what are things you specifically should do while you prepare for an exit, happy to speak with with any e-commerce business owner, whether, by the way, whether it's a brand or a SaaS e-commerce. An e-commerce agency, anything within that space. Happy to have a conversation.
Lovely. Yael Cabilly, Fortunet. You guys have built a really monster investment bank. Yeah, before I let you go, I want to ask you a question I ask everybody. We close this Return on Podcast episode. I'm just curious. You're a high performing person. You're juggling a lot. I mean, we were talking before we hit record. You've got your kids are home for summer like mine are, and you guys are contemplating a move and doing everything else in your life. And how do you keep it together? Like, is there a habit or practice or rhythm or routine or hack that you feel like has given you the ability to really be as successful as you have been?
Yeah. I think first of all, I don't know what's successful. I think in my case, since I have a lot of tasks, what I try to do is referred to habits. So my days kind of look very much the same. I know when I go to sleep, I eat 3 meals a day. I work with the Calendly. I have very specific hours at which you can have those calls with me. There are hours that I lock for the kids. So everything is kind of the same every week and every day, and I make sure I have the time. On the weekend, I do not work on the weekends. I can see emails sometimes, but I will never have a business conversation over a weekend. So I'm not sure this is a real practical advice, but for me, kind of having an order, having planned hours where you're working, and hours where you're not working. That's the only way, at least for me, to perform like you're saying. Then is it successful? I don't know, but at least you're happy, you're healthy. That's important.
Probably is very much the definition of success. I think that's really good advice. I think I similarly juggle a lot by really kind of on purpose directing my calendar and then becoming a slave to my calendar. I want to be on point. If I'm going to have a time to journal, meditate, it's going to have to be the same time every morning. If I'm going to go work out, it's going to have to be at the time to work out. I want to snuggle my kids too, and I want to date my wife. And so, like, when things that are important to me, I want to plan them, because if they are not planned, they kind of, you and I become a victim to our schedule instead of
Yeah,
owning it. And I think, that's actually really good advice to just own your schedule. I think it was Alex Hermosi or one of these guys I heard recently talk about how absolutely dialed in and routined every single day. Bezos is the same way. So if you're looking for the habits of highly effective people, they tend to tell their calendars to obey them instead of obeying their calendars. And I think that's a
yeah,
big deal. Yeah.
exactly.
Awesome. Yael, thanks again for joining the show. We'll make sure your links get out. And guys, for anyone who's made it, 30 plus minutes into today's episode, I just want to say thank you. Your time is so valuable. And Yael and I hope that you grab a couple of nuggets that you can start getting your business ready. And it sounds like if you're anywhere close to being ready, even more than a year, you might want to go ahead and reach out to the right partners and start exploring that exit so that you can maximize it. Yael and her team at Fortunet are great partners for doing that. Yael, thanks again for joining Return on Podcast today.
Thank you. Thanks for having me, Tyler. Always a pleasure.
All right, guys, we'll see you next week. Until then, hope you kill it.